The broadcast is now starting. All attendees are in listen-only mode.
Hi everybody, this is Manoj Abhichandani, and we're expecting quite a few um, participants, quite a few people who have registered for this webinar. So I'm just going to wait a couple of more minutes and then commence in a minute or two. Thanks for your patience. Right. We're going to talk about allocation of self-managed superfund income to members of the fund today, and my presentation will take about 40 to 45 minutes, and then I've allocated about 15 minutes to your questions. Um, uh, Now, we're talking about the fund's income in a financial year, and how does that work, and how does it actually gets credited into your account, and the various things accountants use to allocate income to various members of the fund. We all know Section 17A talks about how many members we can have in a fund. We can either have a fund with one member, or we can have a fund with multiple members. So when we say multiple members, the maximum number of members are allowed are 4 in any self-managed super fund. A person can have multiple self-managed super funds. So if you have more than 2 children, husband, wife, if you have more than 2 children, you can always have 2 funds where other kids also join you as members of the fund. Today, the invite has gone out to a lot of trustees of self-managed super funds. I expect the attendees to be about half-half, say half are advisors and half are trustees. So what I've decided is that I'm going to take matters very slowly, or whenever there's a complex issue, I'm going to slow down and try and make it easier for the trustees to understand the issue. So if you're an administrator or an auditor, superfund auditor, please bear with me there. Now, some of you know me, but those who don't, just a brief introduction. I used to look after about 600 funds, and I've done that for almost 20 odd years. Now I help online SMSF audit. I've written that software. There are about 600 auditors who are using it actively. About 60,000 funds get audited. About 10% of super funds get audited on the system. I also help on technical issues for exempt current pension incomes, where there's one member in a fund who's on pension and the other members are in accumulation. And I help accountants and advisors if they have any queries on self-managed super fund issues. Now, the discussion today is going to be on what the rules are from 1st of July 2017, because earlier on, what could happen is for exempt current pension income, that means some of the income which is supporting a pension could be segregated prior to 30th of June 2017. That cannot happen now, so all the assets have to remain mixed with accumulating members, and the calculation for deduction against exempt income has to be calculated based on the total income of the fund. So the rules have started on 1st of July 2017. So we're not talking about the year which has finished. I'm talking about the current year, that is from 1st of July 2017. I'm going to talk about what is fair and reasonable allocation, because the legislation talks about fair and reasonable. There is a ruling on what is fair and reasonable, and there's a definition of what is fair and reasonable. So we're going to look a little bit into that, because we should be able to understand that if we are trusting a software to an accounting software to allocate income to various members, we should be able to understand what the software is doing, There are quite a few softwares which accountants use who do not automatically allocate income to various members. The allocation is done by a journal entry, and then everybody needs to calculate, all the accountants needs to calculate how the allocation has to be done, and then a journal entry is passed. I'm also quite mindful that some of the attendees are self-managed super fund auditors, and what is their role in checking allocation of income to various members, and what the confusions are, and what are the solutions to those confusions, and how they are supposed to report, if anything, to the tax office. Now, just before I begin, just a little bit of a housekeeping issues. If you cannot hear me, then there is a phone number in the panel. I highly recommend you to use that. The only reason why you will not be able to hear me well is that you don't have a very good internet connection. But if you have a high-speed internet connection, you should not be having any problems. But if you do have a problem, I cannot do anything further than what I am. I'm using a sophisticated mic, and I cannot do anything better than what I have at the moment in place. The second thing is the handout. So you don't have to worry about the pen. You can download, if you look in your panel, there is a section for handouts. You can download my presentation there, and you can also download something which I'm going to talk about. There's an application form for splitting contributions, and I'm going to talk about that a little bit later. Now, I'm quite aware that some of you would be trustees and you'll have some questions. So if you allow me to complete my presentation, which should be about 40 to 45 minutes, and if you can keep on typing in your panel, you will see there's a question box. If you keep on typing your questions there, I will attend to all those questions if the time allows at the end. And those who have not asked a question, I strongly recommend you to stay for the last 10-15 minutes, because sometimes some other people think of something which you never thought of, so it'll be quite helpful. I'll read the question and answer it, so it'll be quite helpful for you to see what other people are thinking. All right, so let's begin and talk about how we allocate income. Now, there is an issue because I'm going to talk about contributions, I'm going to talk about income and allocation of that income. Please do not think that I am giving you any legal advice. I'm not giving you any financial advice. This webinar today is only for educational purposes. So if you're an advisor, I highly recommend that you um, take further clues, or you take clues and you study further in that direction and try and help your clients. This is a free seminar, so there is no free charge. I do not know your circumstances, so I cannot objectively give you any financial advice as far as what you should be doing personally in your self-managed super fund. Now, let's talk about the problem. The problem is that accountants generally do not know what the software is doing, and the common softwares are BGL and Class Super, and it's possible to actually look at a journal entry of what the software is doing. And when you create entries, when you click on create entries on BGL Simple Fund, let's say the desktop software, and you say generate that journal entry, basically what the software is doing is that it checks the date on when the income is receipted by the fund. So let's say if there is a bank account and the interest is received by the super fund on monthly basis. So what the super fund, what the software is doing is on the date of that receipt of that income, it checks what the balances were for each member. Now, if you're in accumulating, obviously your balances does not remain the same because you're contributing more money. So it's possible that on 1st of July you started with a balance, but on that date of receipt of that particular income, the software will check what your balance was. Now, um, uh, interest could be received once a month. If the fund has got rental income, that could be receipted once a month. There could be other types of income like dividend income that could be receipted quite a few times in a year. Let's say the fund has got 20 shares, all dividend paying shares. There could be 40 different stages where the super fund receives income if the dividend is received twice a year. So when you look at that journal entry, it's a very complicated journal entry because that journal entry will determine or will calculate the balances of all the members and credit each and every member. But what it does is that it's creating that complex calculation. Now, that complex calculation is twofold. It does not only look at the income side of it, it also looks at the expenses of the fund. Now, most of the softwares have an override button. Most of the specialist software have an override button. You don't have to worry about what the software is doing on a daily balance method. You can actually override it and you can do things. And in my experience, very few accountants and administrators will use an override button because, very frankly, to tell you the truth, and being working for almost 30 years, they won't know what to override it with. So they won't know how to calculate it, and it's an extra burden, extra time which perhaps the trustees would not pay for, and would not even appreciate. But I highly recommend that if you are a trustee, you should talk to your administrator and say that you want to make a decision on who or how much, which member should get how much of income, and if you are a trustee, you must participate in that part of administration of your fund. Now, the next is point number three. Does the auditor really cares? And I've been an auditor for many years, and I've looked at the allocation which the software has provided. There are a lot of softwares where the automatic calculation is not done by the software. In that case, the accountant and the administrator actually does a journal entry. And when you look at the journal entry, you look at the opening balance of each member and you look at the total income of the fund and see how the money is actually being dissipated, or the income is being debited, or the, sometimes if you have a loss, you could have a debit. There could be an unrealized loss. So the net could be a debit or a credit. So when you look at that, you really, say, does it really matter to me? Because all what matters to me is this is what the trustees have decided, and this is what the allocation is, and that's what the accountant wants. So we're going to talk very briefly on duties of an auditor, and whether there's any leakage of any revenue for the treasury, and what the tax office wants you to do, and what IPRA wants you to do. Now, how to obtain optimum results? What is the best deal for the trustees? We're going to discuss a little bit about that. Uh, all decisions made by trustees must be approved by the trust deed itself. So if any income is not allocated to a particular member, it can be allocated to a reserve account. So reserve accounts should be allowed by the trust deed. So we need to look into our own trust deed and see whether the reserve accounts are permitted or not, and if not, then we need to update the trust deed. We should also look at the legislation, on what the legislation requires us to do, and I'm going to talk about that a little bit. And the software calculations, should they really be ignored, or what merit does a daily balance have? And in my opinion, it has a very low meaning. It should be based on other factors which are more important, which are permitted by the SIS Act. Okay, so first thing is, does the auditor really cares? If you download the SMSF audit report from the ATO website, NAT 11466, And if you already have a copy, then what you're signing is that the distribution, or what you are saying is all those little numbers are all okay, and you have done a reasonable test to provide that there is an assurance that to the trustees that the fund has complied to all the various section, and the section relevant to us is included in the audit report, which is regulation SIS regulation 5.03. So auditors must be very careful, and they are forming an opinion whether the super fund has complied or not complied. Now, let's look at what does SIS regulation 5.03 talks about. It has two components. Um, and it's talking about investment returns at this stage. We're not looking at the cost of the fund. We're not looking at costs such as administration, audit cost, or other expenses of the fund. And who should or which member should be paying for that. Now, the first limb talks about an accumulation fund or a deposit fund that maintains a reserve. So there are two types of self-managed super funds. One type is which has a reserve, and another type which does not have a reserve. 9 out of 10 cases, I would say even more, does not have a reserve. And the tax office is recently, with the introduction of the transfer balance account and total superannuation balance, we talked about that in our previous webinars, is really contemplating whether reserves should be allowed in self-managed super funds. And I'm expecting there will be some changes in legislation, um, uh, and most likely reserves will not be allowed in self-managed super funds. So we go to the second limb, and the second limb talks about that subject to 5.01, which is basically talking about the protection rules, making sure that the member is not unduly charged for certain expenses. The trustee of a regulated super fund must determine the investment returns to be credited or debited to a member's benefits in a way that is fair and reasonable, as between all the members of the fund and the various kind of benefits of each member of the fund. The first thing we're going to talk about is debited. Can an income be debited? Um, Sometimes, and you'll see member accounts. If you are a trustee, you'll see your member account, and you'll see generally there is only one income, either credited or debited. And usually it's a credit because all the income of the fund is coming through, and then all that income gets collected, or uh, moved through a funnel, through a operating statement, where we have all the types of income, and then there are certain expenses, and there is tax calculation, and there is a net income. Now that net income is the one which we are talking about, which goes to various member accounts, and those member accounts have a credit balance in the balance sheet. Now, it is possible that you'll get a debit balance, and the reason is mostly to do with unrealized gain, because you could have a huge amount of rental income or dividend income, but it's possible that the market values of the assets have changed, and the market values have actually dropped. And because of that drop, your member balance actually gets reduced. And the way the balance gets reduced is by debiting or reducing your member balance from the opening balance with this unrealized loss. So SIS regulation talks about what is fair and reasonable, and it passes the onus to actually to the trustee of the super fund. So it's basically not up to the administrator. Although the trustee can hire an administrator, the trustee can hire an accountant, but it is up to the trustee of the super fund to actually credit or debit the investment returns to the various members of the fund. So if you had a reserve account, basically the profit, you don't even have to credit directly to any member. If you had a profit, you could transfer all the profit to a reserve account, and from the reserve account you can leave the money in reserve account if you wanted to forever and ever. So you would technically have five accounts: one for member one, one for member two, one for member three, one for member four, and one a reserve account. And each member could have several accounts, but you are allowed to have only one accumulation account, but you can have several pension accounts. You can have pension one, pension two. So if a member was on pension, he could have five or 10 or even one pension account, but only one accumulation account. So all of a sudden, we have a fifth identity, if you would like to call it, that is the reserve account. So all the profit can go to a reserve account and may never be allocated to any member account. Now, if you transfer from a reserve account to a member account, the rules are very simple, because the allocation otherwise will be counted as if it's a concessional contribution. So if you transfer less than 5% of the member balance, that is fine. Or if you allocate to all the members in fair and reasonable manner, then it is fine. But if you do not do that, that is, if you favor one member more than the other member, then the amount which is higher will be considered as if it's a concessional contribution, and then it will be tested against the concessional contribution cap amount. So if you're running a reserve, just be watchful of how in the financial year in which you do the allocation, on how that allocation is treated against the contribution cap amount. Now, what is fair and reasonable? Now we're looking at the second limb where there is no reserve account. Basically, a particular member or members are not favored over the others. Now, assume that this is a one member fund, and the member has got, say, more than 1.6 million. And if he has more than 1.6 million, we know from 1st of July 2017, a transfer balance account has to be credited of whatever moves into retirement phase. And we know we cannot have a transfer balance account higher than 1.6 million. So, if your account balance was more and you were on pension last year or before 30th of June 2017, you will have an accumulation account, because on 30th of June 2017, we would have to, um, the fund was fully segregated. We had only one member, so that we had to commute the pension on 30th of June, and on 1st of July, you would have an accumulation account as well. So, in the current year, that is the 17 and 18 year, we have one member, but we have two accounts. So this regulation, the Part 2 limb, says that we should be fair and reasonable to the various kind of benefits of each member of the fund. Now, if we have two or more members in a fund, then it becomes very complicated, because if I'm a one member fund, then either my accumulation account is getting credited or my pension account is getting credited, but at least all the income is going to one person. But here we have two members, or we can have more than two members. Then we look at the part one limb of the second part, where it says that the amount should be fair and reasonable. Now, what is fair? It's to be decided. What is fair. If it's me and my wife in the fund, uh, there are lots of things which happen in a household, uh, which sometimes are not considered fair. Let's say one person drives and the other person doesn't drive, and the other person get driven every time. One person does the dishes and the other person doesn't do the dishes, and that's how it works. One person throws the rubbish bin out every day and takes the bin on a weekly basis outside. So what is fair is to be decided among the trustees. Now, the way I look at it, if the other member agrees that member one, so member two agrees that member one should be credited with all the income, and that's fair because he's done all the work, he's done all the investments, he looks after the rental property, and he decides or she decides how how the fund will run. So that person deserves all the income. Now, is it reasonable that the older member, because you're like a family group, you know, and we know that you cannot commence a pension till you reach a preservation age, which is age 57, which should be 58 next year. So, so is it reasonable that the older member, because you're a team, husband wife, you're a team. So isn't it reasonable within your household that all the income should be given to the person who's going to reach the preservation age first, so that if you haven't reached 1.6 million, who's going to retire first? Maybe it's the younger person who's going to retire first, because it doesn't matter whether you've reached the preservation age or not, because if you've reached the preservation age and if you're still working, all you do is you can get a transition to retirement pension. But if you get a preservation age, you can get $200,000 as a lump sum and you don't pay any tax on it. So if you want to withdraw that money can come out of the super fund. So who's going to retire first? So it'll be reasonable that that person at least gets $200,000 and that income can be withdrawn as a lump sum. But if it's going to be, or if that person retires and wants to, instead of take a lump sum, commence a pension in the fund, maybe they don't have $1.6 million. Maybe they have only one million. So they're 5 years to retirement. So let's give all the income to the person who's going to retire first, and that'll be reasonable, won't it? Because there are some reasons behind it. But is it favoring the other member? I think it is, because the other person also contributed, the other person also had money in the fund. So, what is fair and reasonable is to be judged. And also, what does the trust deed say about crediting income? I've seen some trust deeds which have a very complicated way of working out on how allocation of income must be credited to the various members. Now, in an accounting firm, usually you can't just say that this trust deed says this, so all the other trust deeds for all the super funds would say the same thing. That's not true. A lot of solicitors who write these trust deeds have a different interpretation of fair and reasonable. So it's quite possible that the accountant would need to read each and every trust deed and then use the terms of those trustees. And also, I think it would be a good idea that the trustees should be talking to their auditors, and because at the end of the day, the auditor has to comment on the allocation, and then if there is a breach or if there is a breach going to occur or is about to occur, needs to discuss this with the auditor and say, would you have a problem if I give my wife all the income this year? And if you don't have a problem, then obviously the trustee can instruct the accountant to prepare the accounts in that manner. So there is no one answer to this question. So what we're going to do is we're going to explore into various options and see how we're going to allocate income to the various members. Now, I've also looked at a situation where both the members are in pension phase. So does it really make a difference who gets the income if both are on pension? Because let's say one member has got 800, the other member has got 1 million. We have not breaching the 1.6 million. Even if we do, it doesn't matter. We can go over 1.6 million. So, I mean, as far as the auditor is concerned, uh, how far is he going to test it, and is it really material on who gets the income? Because the audit report actually asks the auditor to see and report whether it is material or not. And I think it doesn't really matter if all the income goes to one person, because what difference does it make at the end of the day? It's just that one person will be able to withdraw a little bit higher and a little bit lower. But if you consolidate the two, the total withdrawal would be more or less the same. So again, I'm not saying that it does not matter really. What it matters is that if there is a discrepancy in daily method, then perhaps or maybe in these situations we should just accept what the calculator is, what the software is calculating, and just move on. Now, it gets complicated when one member is in pension phase and the other member is in accumulation phase. Because what happens is that the member which is in pension phase, the income earned by whatever money is in the super fund does not pay any tax. But for the member who's in accumulation, whatever that member has is taxed. Whatever that member has assets in the fund, whatever those assets earn income, are taxed. The problem is that from 1st of July 2017, we cannot segregate certain assets and say that these are pension assets or these are accumulation assets. So all the assets have to be put together, and then we have to, um, see how much are pension assets, and we divide those pension assets by total assets, and then we work out a percentage. And usually, uh, a fund would need an actuarial certificate. We offer those certificates on trustdeed.com.au. So when we cannot segregate these assets, it becomes quite difficult for a trustee to actually work out, because you must remember that member balances are not constant during the year. If you're on pension, your balances gets reduced because you're withdrawing a pension, and if a member is in accumulation, the opening balance is different than the closing balance, because there could be new contributions coming in. Maybe you're contributing once a year, once a quarter, once a month, or once a week. So your balances keep on moving. And the other thing is the contributions itself. The income of the fund, can a contribution be allocated to another member? That's an interesting thing, and we're going to talk a little bit more about that as well. Now, let's just look at a example where there are two members, and what I'm saying is that if one member is on pension and the other member is not on pension, I've taken a very easy example. We can segregate the asset based on who owns that asset, whether it's a accumulating member or it's a pension member. But we cannot segregate it for ECPI purposes. For tax purposes, we cannot segregate. For tax purposes, we have to combine all the income and then work out the tax on the total income. But the underlying asset can be allocated to each and every member. And then if we allocate high income assets to the person on uh, who is on pension, then it's possible that we get a better result. Now, for some of you, you may not know, because you are in accumulation phase and you have never dealt with exempt current pension income. Uh, it is that part of income which is exempt from tax. So let's just go into the example. So there are two members with equal balances, and one is on pension, one is not on pension. So that means that because the balances are equal, so part of the income is exempt. And because the balances are equal, so 50% of the income is exempt. So let's say there are two assets and they have equal market value. So let's say there are two properties side by side and they are of equal value. And let's say one property was empty for half the year and the other property had a tenant the whole year. So asset one earned $50,000 and asset two earned $100,000. So the total income of the fund is 150,000. Now, because one member is on pension, so half the income is deductible. So exempt current pension income deduction is 75,000. So the taxable income of the fund is 75,000. So we're ignoring all the expenses. We're just looking at income of the fund. So the tax of income on the fund is 11,250, which is basically 15% tax on the person who is in accumulation. Now, because uh, because the person who's on pension does not pay any tax, all the tax must be allocated to the member who's in accumulation. So the total income being the remaining income being 188. So what we'll do is the accumulating member has an income of 50,000 minus the tax amount. Uh, this uh, this 11,250 must come out from the accumulating member. So if we say this asset number one belongs to the accumulating member, then all the tax comes out of this income. So the allocation can be 38,750. And since asset two has earned higher income, we don't have to take out any tax. So we can actually distribute 100,000 to the pension account. Now you'll say, why do that? Because we can just say half and then carry on. The If you do half, then you will not get this benefit. And the benefit is that next year, because you've allocated higher income to the pension member, the exempt current pension percentage, this percentage will be different because it's equal in this year. But if you allocate 100,000 and only 38,000 to the pension member, if you allocate 100,000 to the pension member and only 38,750 to the accumulating member, then next year percentage would be leaning more towards the pensioner. So that means more income would be exempt from tax. Now, what can you do that? What you have to look at is, does the trust deed allows the asset allocation to members? Now, here you will notice that what we have done is we have calculated the tax according to the ECPI. We have not segregated it. We are paying tax on this 100,000 because we have included as total income. So we have combined the total income of the fund, but as far as allocating the income of the fund after tax is what we have done. So what I'm saying is the trustees, before they think they can actually do this, they have to look at the trust deed and see whether this segregation is possible, whether the trust deed actually allows them to do it. And when an auditor looks at such a fund, he has to see whether the trustee decided that they are going to do it this way. And I guess it should be allowed by the trustees, and I don't think it becomes a contravention in any way on how this income has been allocated, and it does not need to be reported to the tax office. The auditor also needs to look at the trust deed to see whether this kind of allocation is allowed or not. Now let's look at a different situation. Now, sometimes you have a member who's on pension phase, and the second member um, uh, is either retiring during the year or he has reached that preservation age and he's commencing a pension in that financial year. So we look at two different situations. This is the first situation where income is receipted evenly during the year. So we'll see that this is the whole year. So we've received income $1,000 every quarter in that financial year, and we have a member. This green line denotes that this member one is actually on pension, and member two had the same balance, $100,000 at the beginning of the year, but that member was in accumulation phase. And then after quarter one, member two decided to commence a pension. So we have a green line after the first quarter. Now, from 1st of July, what the tax office is going to do is when they work out the exempt current pension income, they're just going to look at the period where they were accumulating and pension members. So you can see that this period is the only period which the tax office is going to look at, because in this period we had a pension member and we had an accumulating member. For all these remaining periods, for this period, the tax office is going to ignore that there is any income, because the whole income is segregated and tax free, because all the members are in pension phase. So if you look at the calculation, the income is $1,000. So half of it would be will be exempt because they both had the same balance, and we'll have 15% tax on $500 to be paid. And the opening balance would be, because you have to pay the tax, so you will pay a certain amount of tax, and then that tax will be allocated to member 2, and income will be allocated for that quarter to member 2, and then we'll commence the pension after the first quarter. Now, this is fine. There's no problem with that because you can use these calculations. But sometimes we have noticed that all funds are not the same, and sometimes income is receipted unevenly during the year. So it's quite possible when we had an accumulation account, we receipted some income. It's quite possible that there could be a capital gain, or maybe fixed interest term deposit got matured, and then we receipted some interest income in the first quarter, and then maybe in quarter 2 there was no income, in quarter 3 and quarter 4 there was very small income. So what is going to happen is your percentage of tax is going to go up, because all of a sudden, instead of 1,000 in the previous, 500, because we had 50%. So instead of this 1,000 being um, distributed or being paid tax at 15%, now we have a higher amount of income which will be considered subject to tax. And you will see that half of that income, 3,000, half of that income will be subject to tax. Now, what we suggest in this case is when we have uneven income, so we've used the income scale to be the same as the previous calculation over here. So what we have seen is that instead of converting the whole amount into pension, we can have some amount. In my example, I have used $1,000. You don't even have to have $1,000. You can even have $1 in accumulation. So it'll be a good idea at this point of time, instead of commencing a pension or with the full $100,000, it'll be a good idea to commence a pension with a little amount and leave something in the accumulation account. Because what will happen now is that for the whole of the year, we had, for this period, we had the whole 100,000, and for this period, we had some figure, some amount in accumulation phase. So what will happen is, instead of this amount being taxed, the whole amount will be taxed, but then we will get 3/4 of credit, or 3/4 of the whole year of credit of pension balance as well. So I've done some pension calculations out here, and this one thing has to be noted is, although the income has to be included, but because the period of $99,000 is also included for 3/4 over the period, then what happens is, instead of getting a 50% percentage on $3,000, we get a higher percentage, and this will actually result in very substantial tax savings. Now, in our example, we've just used 3,000 income. There could be some funds with a very high capital gain. So I'm sure you'll be able to download the download the presentation and have a look at what exactly I'm talking about. So you have to look at the fund and see whether the whole amount should be converted into pension or not. Now let's look at what type of income which can be allocated to other members. We've seen all different types of income which go into the operating statement: rental income, dividend income, interest income, capital gain, realized or unrealized. Now let's look at contributions. What type of contributions can a fund have? We know that for small business, you can there's a relief, so there could be CGT, small business contribution. These contributions cannot be allocated to another member. Spouse contributions cannot be allocated when a spouse contributes for you. But concessional contributions, these are the contributions which your employer contributes and which you salary sacrifice with your employer. And from 1st of July 2017, whatever you contribute, even if you are on salary and there is no salary sacrifice arrangement, in the months of May and June, just wait and see. You'll get a lot of insurance people knocking at your door, all financial planners calling you and telling you, have you contributed the maximum amount? By the way, the maximum concessional contribution amount is $25,000, because even if you're on a salary, if you make a contribution and you tell the super fund that you intend to claim a deduction for this contributions up to the cap amount, you will be able to claim a deduction in your individual tax return. So concessional contributions can be allocated to other members, to only the spouses. Non-concessional contributions cannot be allocated to another member. Downsizer contributions cannot be allocated. And very soon I'm going to put up another post for a webinar on what is the new downsizer contributions. There's no rush. This legislation commences from 1st of July 2018, so you cannot make these contributions at the moment anyway. Rollovers cannot be allocated to because they're considered as non-concessional contributions. Government co-contributions for a member again uh, cannot be split with other members. So let's look at how concessional contributions can be allocated, and the answer is again in the regulation part 6.7, and talks about what is the maximum amount you can split. So 85% of any concessional contributions for that financial year. So if you make a contribution, say a contribution was done before 30th of June 2017, on the following year, 85% of that contribution can be split to your spouse. Now, the procedure to do that is very simple. There's a journal entry to be made where you remove 85% on 1st of July for all the contributions made in the previous year. And if you look at the handout section in your panel, you will see that I have provided a PDF file. If you download that PDF file, basically it's the person, both parties have to sign, and it's only available to spouses. And when I say spouses, since the gay rights, the legislation has been changed to include same-sex marriages and partners. So if you if you look at that form, basically it's the amount of the concessional contributions which the contributor agrees to split, and the receiver actually has to accept it as well. So both parties have to sign, and once that is implemented, a journal entry basically reduces the balance of the member who has contributed and increases the balance of the receiver. Now, why would you split contributions? Uh, Very simple. This legislation came in sometime in 2006. It's been there for quite some time, and there were some changes in Division 6.7a, because earlier non-concessional contributions could also be split, but then they stopped that. Um, so if you, it'll be very difficult to have spouses born on the same day. I mean, I'm 5 years older than my wife, almost 5.5 years. So if she contributed, I wanted all her contributions. What would that mean? That would mean that my balance will go up and her balance will remain where it is, because if I have more balance, I will get more income, being fair and reasonable. So if she split all the contributions, my balance would keep on growing and her balance would remain there. And when I reach the preservation age, I go on pension first, 5 years before her. And once I'm on pension, then whatever I'm contributing, because if I'm still working, then I can start building her balance up. So this is one strategy I've seen. I've audited hundreds of funds, and I see vast discrepancies between the ages of the two spouses, and I wonder why they don't use this strategy. Um, Sometimes it'll be a good idea if your balance has already reached 2 million. Sometimes it'll be a good idea, and because you've already started your pension, it'll be a good idea, because the second person, like my spouse, her balance is very very low. So it'll be a good idea that if you because I'm going to reach the transfer balance of 1.6 million. So it'll be a good idea for me to actually contribute to her instead of. So it just depends on each fund, and each fund would have a different answer. So, higher balance basically means more allocation of income to that member. So, by splitting the concessional contribution, you can actually play around with the income of the fund as well. Now, we till now we have just looked at the allocation of income. We haven't talked about allocation of costs. That is in SIS Regulation 5.02, and that talks about that trustee must ensure that cost of the fund incurred by the fund as a result of operations are distributed again in fair and reasonable manner as between all the members and the kinds of benefits of each member. Now, there are certain costs like insurance costs which are specific to a particular member. I'm talking about life insurance. So those costs can be allocated to that particular member. Sometimes we see that a financial advisor has been engaged by one spouse, and it will be appropriate for the trustee to actually allocate that cost to that one particular member. Also, we earlier on looked at allocating a certain asset. So it can be possible that the trustee decides that whatever the costs are for that particular asset will also be allocated to that person instead of being shared by other members of the fund. Now, let's look at the auditor's duties in checking whether the allocation is done properly or not, and the auditor to actually check whether the software is doing the correct calculation or not. Now, this is years and years back, and I'm not going to name the software. The software was calculating this allocation, but those calculations were actually wrong, and I had to actually communicate with the software designer. The person I ended up calling quite a senior person, and then I did a manual calculation which was quite extensive, going up to about 200 rows of Excel sheet, and I to just to prove that software is actually incorrect. So, I mean, as an auditor, if we are going to trust that allocation of income, before we do that, we must test whether the software is actually performing what it is supposed to perform or not. So this is something we need to check maybe once. If you have a client who's using BGL 360, have you checked 360? Have you BGL 360 whether it's calculating correctly or not? Look, I have no doubt that it is doing it, but as far as you're concerned, you are the one who's actually auditing the fund and signing off that the allocation is correct. And if it is a minor difference, then maybe it's not material enough. But I would highly recommend that you go into that procedure. And then there are lots of accountants who don't use the specialist software. They use something like Handy Ledger, or sometimes they use MYOB, and these softwares are not capable to make these type of calculations. So what the accountant then does is they make a journal entry, and then I've noticed many accountants just look at the opening balance. They don't even care about the closing balance, and then definitely don't care about the daily balances, because if there is a big movement or loss, or sometimes they'll take an average of the opening and the closing. So you need to get into one step a bit closer, because it is your onus is on you to check whether the allocation is correct or not. And if it's not according to daily balance, check the trustee, check the trustee minutes. Have they decided that certain assets and certain income from those assets is being allocated to a particular member or not? And of course, is it a contravention or not? Yes, it's a contravention if the amount is material, and it is obviously if the amount is immaterial, then obviously you will just let it go. Um, that's it, folks. This is one area where I've noticed very few people look at, very few people pay any attention to it. So I hope I've picked up a few points which will help you, especially auditors, to have a look at and uh, see what they can do in the funds which they're auditing. It's question time. Those who have not asked a question, or those who don't want to know what other people are asking, can exit the presentation. I'm going to, in the next 5 minutes, read the question and then try and answer to the best of my ability. Okay. Now, I've got a question from uh, Raj Pro, and says the question is, please throw light in the end of the session on allocation of ECPI in pension in taxable and tax-free proportions. The taxable proportion is always reduced. I did mention it when we have a fund where there is a pension member and there's an accumulation member. The pension member does not pay the tax. It's always the accumulating member which pays the tax. And this is accumulating member, has correctly pointed out by you, has a tax-free and taxable component. uh, Tax is on taxable income. Taxable income is the taxable component. So the tax actually reduces the taxable component of the accumulating member, and it has no effect at all on the tax-free proportion of the accumulating member. Right. Next is a question by Boni. The question is, one of the member of the super fund has rollover all the amount to other retail super fund. Can the super fund still keep her as trustee but without any benefit? Now, Boni, as far as I understand, a person can be a member of the fund if that person has any money in the super fund. If there is no money in the super fund, then obviously that person cannot be a member of that fund. So before you rolled over the monies, I would highly suggest that leave $1 or so in there, so that the person remains a member of the fund. But if your question was, can a member remain a trustee of the fund, I would say yes, but there is a provision for one member fund. So we had two members and one exited. So you can exit the member as a member of the fund, but you are allowed to have in a fund where there are individual trustees, you're allowed to have two individual trustees, and if there is a corporate trustee in a single member fund, you are allowed to have another director of that corporate trustee. So, if there were three members, you have a problem. But if there were two members and one wants to get out of the fund, then the person can remain a trustee, but to be a member of the fund must have money in the fund. How do I download the presentation? Philip, in your panel, you will see uh, there's a arrow to download, and if you click on that, if you don't get that, just contact us via the reminder for this webinar on that email, and then we can send it to you. Okay, next is from Robert. It says, presume where complete segregation between accumulation and pension fund, that income does not require allocation, that is separate bank account and equities. Okay, Robert, from 1st of July 2017, this segregation is not allowed at all for income tax calculation purposes. So even if you have separate bank accounts and separate equities and separate shares, that's fine. For ECPI calculations, you will have to total all the income, but you you can, like, allocate income to various members after the tax has been calculated. So I suggest that you go through my slides again and then try and uh, grab the crux of the matter. All right. Annette is saying the handout is not in PDF format. It's a PowerPoint presentation, and usually I've been requested by many members to actually upload the presentation in PowerPoint because they use it for training purposes in-house. Right, the next is from Bonnie again. This super fund has 4 individual trustees. So going back to that question, can the super fund keep her as a trustee but without any benefit? So Bonnie, the answer again is that a person can be a member only if there's money in the super fund. You won't have a member balance. If you won't have a member balance, obviously that person is not a member. And please look at section 17A, because for individual trustees and for corporate trustees, you will notice that all trustees must be members and all members must be trustees, and in case of corporate trustees, all members must be directors of the corporate trustee. So have a look at section 17A, and probably that will help you a bit. Okay, I have another question. Assume fund is in 100% pension phase and they are earning $10,000. Should this income be allocated to taxable component of the member balance or in proportion to the balance of tax-free and taxable income of the member? I think it's this question from the same person. You have to, you're saying the fund is in 100% pension phase. They are earning $10,000. Should the income be allocated to taxable component of the member? Okay, I know what you're asking me. What you're saying is the fund is in 100% pension phase, but they have a different proportion of taxable and tax-free. All the income is allocated to the members on whatever the proportion was at the beginning of the pension account. So all the incomes are credited to all the pension accounts in the same proportion of taxable and tax-free every year. And whenever there is a pension, I'm giving you an extension to the answer, whenever there is a withdrawal, the pension amount also comes out in the same proportion of taxable and tax-free. So I hope I've answered you. Have a look at the proportion rules in the Income Tax Act, and then you'll see what I'm talking about. I don't have that section number with me at the moment. Next question is from Roger. Says, where two members have 800K each, one on full pension and one on TTR pension, can the tax calculation still be on segregated basis as the fund is less than 1.6 million? Okay, now when you have a TTR pension, it is considered as if it is in accumulation account. It is not in retirement phase, and because it's not in retirement phase, now this is the legislation from 1st of July, so you still cannot use the segregation balance method, because because TTR basically is not in pension phase. Next question is from Roger again. I think I can see there are about 15 more questions to answer, but I'm running out of time, so I'll just take one more question and then that'll be it. I can see that one person, Raj Proy, has got a lot of questions. So, feel free to ring the office and then perhaps I can answer you one on one. So I'll call it a day now, and thank you very much for attending. And I'll let you know about the presentation on downsizer contributions. You know the page where you booked today's webinar from, so keep on visiting that page and you'll see it'll be uploaded there soon. Thank you very much. Bye for now.